Imagine a world where artificial intelligence is so overwhelmingly powerful, like we are actively restarting dormant nuclear reactors just to keep the servers plugged in.
Right, yeah.
And then, pan over to the exact same economy and you see families in the bottom 25% literally putting their weekly groceries on layaway just to survive the month.
It's a massive structural paradox. I mean, we are looking at a system that is simultaneously reaching the absolute bleeding edge of digital capability while, violently colliding with the oldest physical constraints on Earth.
And that collision is exactly what we are wading into today. Welcome to the deep dive. We've got our hands on a stack of highly detailed institutional intelligence from May 2026.
Yeah, some really dense material here.
Absolutely. The centerpiece is this massive institutional report titled MacroPulse 2026, The Friction Point, along with several comprehensive U.S. equity sector deep dives. Our mission today is to decode how intelligence capital, which is sort of the new institutional framework for AI, is hitting a wall of hard physical realities.
Right. We're talking about tapped-out energy grids, massive sovereign debt shifts, and an aging population.
Exactly. So if you're out there trying to manage a portfolio or maybe navigate a shifting career landscape, or you just want to see where the tectonic plates of the global economy are moving, understanding this structural realignment is your shortcut to being genuinely well-informed.
Well, the premise of this realignment is that the fundamental rules of the global economy have just permanently shifted. Like the era of zero interest rates, which, defined the entire last decade and fueled so much speculative growth.
The free money era.
Yeah, the free money era is dead. Central banks around the world are locked in what the analysts call a simultaneous hold.
Right. So let's put some actual numbers to that hold. The Federal Reserve seems to have settled at a terminal rate of, 3.25% to 3.5%.
Correct.
And global inflation has found this really stubborn new floor right around 3%. So we are clearly not going back to the old 2% target.
No, we really aren't.
But I think the natural question you'd ask is why? I mean, if the Fed is holding rates high, shouldn't that eventually crush inflation back down to the old normal? Like, wouldn't things just reset?
In a theoretical vacuum, perhaps,
Yeah.
but the 2026 economy is dealing with what they call the 3Ds. So that's deglobalization, decarbonization, and demographics.
Okay, break those down a bit.
Sure. So we are actively fracturing global supply chains to move away from geopolitical rivals, right? That's the deglobalization. Then we are spending trillions on a massive green energy transition.
The decarbonization piece.
Exactly. And structurally, our workforce is just aging out. And all three of those macro forces are, by nature, inherently inflationary.
Because they require huge upfront costs, right?
Yeah, massive upfront capital expenditure, and they reduce overall efficiency in the short term. But, if we really want to trace the most acute macro shock of 2026, we actually have to look at Japan.
Oh, right. The Bank of Japan normalizing their rates. I was reading that section, and it's basically like the global economy was borrowing from a rich uncle who never charged interest.
That's a great way to put it, actually.
And suddenly that uncle starts charging,
Yeah.
and everyone's budget just completely breaks.
That is a highly accurate analogy. Mechanically, for decades, Japan maintained policy rates at or even below zero, and this fueled what we call the global carry trade.
Which means what exactly for the average investor?
So large institutional investors would borrow cheap yen, take that nearly free money, and invest it in higher yielding assets around the world, particularly U.S. treasuries and equities.
Wow.
Yeah, and that constant flow of cheap liquidity artificially suppressed global borrowing costs for literally 20 years. But now the Bank of Japan has normalized its rate to 1.0%.
Which just completely changes the math on everything.
Completely. The liquidity floor has been removed. Capital is flowing back to Japan, which essentially pushes up the cost of borrowing for everyone else globally. Money is simply, fundamentally, more expensive to access.
Right. And what the MacroPulse report highlights is that this expensive money is really just one side of the vice. Like, if inflation is stuck at 3%, it's not just because of central bank policies. We are all paying these invisible, structural, physical costs embedded in every single thing we buy.
Yeah, the report identifies these as structural taxes that the Federal Reserve simply cannot control by tweaking interest rates.
No.
You can hike rates to 10% and it won't fix a broken supply chain or a flooded factory.
So true.
Two of the most prominent ones they mention are the security premium and the insurance tax.
Okay, let me push back on the security premium for a second.
Right.
Because we hear a lot about reshoring, right?
Sure.
If a company moves its manufacturing out of a high-risk region and builds a brand new facility in Mexico or Vietnam, aren't they solving that problem? Like, why are we still paying a premium if the supply chain is theoretically safer now?
Well, because safety itself is expensive. I mean, we
Mhm.
have fully transitioned away from the just-in-time manufacturing model.
Run the ran everything for decades.
Exactly. That old model, optimized for maximum efficiency. Parts arrived at the factory on a Tuesday and were assembled into a product on a Wednesday. It was incredibly cheap, but highly fragile.
Yeah, one blocked canal and the whole world stops.
Exactly. So now companies operate on just-in-case manufacturing. They realize the world is simply too volatile to trust a perfectly timed shipping schedule anymore.
So they just stockpile.
They do. Major manufacturers are now holding roughly a 25% safety buffer in their inventory.
Wow, 25%.
Yeah, that means 25% more microchips, 25% more lithium battery cells, just sitting idle in domestic warehouses. And you have to buy that inventory, lease the warehouse space to store it, and finance the entire operation at today's higher interest rates.
And I guess that carrying cost acts as a permanent built-in drag on corporate margins.
Exactly, which is ultimately just passed down to the consumer as a price increase.
Which perfectly brings us to the insurance tax, which, honestly, I found to be one of the most sobering concepts in this entire stack of documents.
Oh, it's arguably the most regressive drain on consumer spending right now. It's driven by extreme climate volatility. So, more frequent storms, unpredictable fire seasons, property and casualty insurers are systematically retreating from high-risk geographic zones.
Yeah, they just won't write policies there anymore.
Right. And reinsurance costs, which is the insurance that insurance companies buy to protect themselves, those have skyrocketed.
Yeah, and the report estimates this invisible tax is adding 45 to 60 basis points to the consumer price index.
That's right.
So just to decode the jargon a bit, we are talking about roughly 0.5% of overall inflation, which, it sounds like a rounding error on paper.
It does.
But when you apply that to the entire CPI, the measure of everything a family buys, it translates to hundreds or even thousands of dollars a year, literally drained from an average household.
And crucially, it's non-discretionary. You can't just choose to skip insuring your home, your car, or your small business. So it functions as a direct, mandatory tax on disposable income. The Fed has absolutely zero levers to pull to make insurance cheaper.
Wow. Okay, so we have these immense geopolitical and environmental buffers on physical goods. But then when you read deeper into the sector deep dives, you realize the ultimate economic bottleneck of 2026 isn't moving boxes across an ocean.
No, it's moving data.
Right. The report calls it the 100-gigawatt friction point.
This is where the concept of intelligence capital truly collides with physical reality. Artificial intelligence has rapidly evolved past the simple chatbots we saw a few years ago. The current paradigm is agentic orchestration.
Well, let's break that down, because agentic orchestration sounds like a phrase a consultant invented just to sell software.
Fair enough.
What does that actually mean in a real functioning company?
It basically means autonomous software agents acting independently across enterprise systems. Like, they are not just drafting emails for a human to review anymore.
Right.
These agents are actively managing live supply chain logistics, dynamically rerouting shipments, reconciling complex corporate finance ledgers, executing code. They operate in the background, making thousands of micro decisions per second.
But the catch is the power grid. I mean, we built the world's smartest digital brain, but we are genuinely struggling to find a place to plug it in.
Exactly.
The report notes that global data center electricity consumption is topping 1,000 terawatt hours.
Which is just staggering. To contextualize that scale, AI training and inference clusters operate at 90% plus utilization rates.
Wow.
Yeah. Unlike a traditional office building where the lights, turn off at night, these server farms run at maximum capacity 24/7. They require massive, constant, carbon-free baseload power.
And this dynamic has birthed the concept they call inference economics.
Right. Because energy now accounts for up to 80% of the operating expenses for these AI clusters.
Wow.
The price of local electricity has basically become the direct proxy for digital compute costs.
Meaning, if a regional utility company raises industrial electricity rates by just 2 cents per kilowatt hour, the cost for a corporation to run their enterprise AI model rises in lockstep.
Precisely. It is the absolute convergence of the digital and physical realms, and it is driving this radical reallocation of capital, creating what the analysts call the intelligence nuclear complex.
Which is how we get these incredible real-world developments, like Microsoft signing a 20-year agreement with Constellation Energy to literally reactivate a dormant nuclear reactor at 3 Mile Island just to secure dedicated power for their AI operations.
Yes, and that single contract redefines commercial real estate. We are seeing an explosive boom in specialized data center real estate.
Just raw land, right?
Exactly. Raw land with no buildings on it is commanding a 40% valuation premium simply for having permitted grid access or just being adjacent to a future nuclear site.
And you contrast that with traditional commercial office spaces in urban cores, many of which are facing a literal existential crisis right now.
Yeah, it's night and day.
If your company is entirely run by distributed autonomous agents, you just don't need a massive skyscraper in Manhattan to house them.
Exactly. Capital is violently rotating away from housing people at desks toward housing servers in liquid cooling racks.
But that raises a massive question about the human element. If capital is rotating away from desks, what happens to the people who used to sit at them? Like, this autonomous AI revolution is fundamentally rewiring human capital.
It is. The 2026 labor market is entirely bifurcated. On one end, we have a phenomenon defined as entry-level obsolescence, because agentic AI has effectively automated about 80% of routine junior functions. Basic data labeling, junior financial modeling. First-pass legal discovery firms are simply no longer hiring entry-level classes at historical volumes.
See, I have to challenge the long-term viability of that. If you cut off the entry-level pipeline because AI can do the grunt work, how does anyone ever become a senior worker?
That is the million-dollar question.
Right. You can't just magically spawn a 10-year veteran with deep institutional knowledge out of nowhere. It sounds like a generational traffic jam.
You are identifying the experience gap, which is a major concern for corporate boards right now. Companies are essentially sacrificing future talent pipelines for immediate margin expansion.
Which seems so short-sighted.
It is, but this dynamic is being complicated by the other end of the labor spectrum. We are currently hitting the peak 65 wave, which is the largest single cohort of the population reaching retirement age in history.
Okay, so normally that would cause a massive labor shortage, right?
Normally, yes. But the report details an incredible counterforce to this retirement wave. They call it the biomacroeconomic shock of GLP-1 weight loss therapeutics.
Yeah, I have to admit, when I first read this section, I was highly skeptical. Like, are we really saying a class of metabolic drugs is actually moving the needle on the gross domestic product of an entire country?
The math strongly suggests it is. GLP-1 therapeutics are improving metabolic health on a population scale. And when you deploy that across tens of millions of workers, the second-order economic effects are profound.
Like what, specifically?
Well, you see a massive reduction in workplace absenteeism. Millions of lost hours previously attributed to chronic joint pain, mobility issues, and obesity-related illnesses are being recovered.
Ah, so it's a huge productivity dividend.
Exactly. The report estimates this recovered labor participation is actually adding 15 basis points to U.S. GDP.
That's wild.
Furthermore, actuaries are actively revising their tables because these therapeutics are compressing morbidity by an estimated 3.2 years.
So people aren't just living longer. Their healthy, active years are extending.
Right. They are able to remain in physically and mentally demanding jobs far deeper into their 60s and 70s.
And it is creating entirely new winners and losers. You have older workers staying in the system longer, while the traditional junk food and highly processed beverage sectors are getting absolutely crushed.
Oh, totally crushed.
The data shows overall caloric intake in households utilizing these drugs has dropped by up to 8%. But returning to the tech and corporate labor side, if AI is hollowing out the bottom and GLP-1s are keeping the older generation working, what happens to the highly skilled workers in the middle?
Well, companies are engaging in intense labor hoarding. Having been deeply scarred by the severe, expensive talent shortages of the early 2020s, corporations are desperate to retain their top-tier technical and managerial talent.
Because the cost of losing that institutional knowledge and then trying to rehire a senior software engineer or an AI orchestrator in a tight market is astronomically high.
Far higher than the cost of simply keeping them on payroll during a soft quarter. Firms are choosing to absorb elevated wage costs today, intentionally taking a hit to their short-term operating margins in anticipation of the massive productivity dividends AI will deliver down the road.
Okay, so let's connect the dots here.
Right.
We have corporations hoarding expensive senior talent, and they're also hoarding expensive physical inventory with those just-in-case supply chain models. And they are passing all those compounded costs onto the consumer, who is already being drained by 3% baseline inflation and spiking insurance taxes.
Yeah, it's a lot.
How is the consumer actually bearing this load?
The short answer is they are fracturing. Consumer solvency in this economy is deeply K-shaped.
Meaning the lines diverge completely, the top goes up, the bottom goes down.
Precisely. The top 20% of households are largely insulated. They are riding the immense wealth effect generated by the AI equity boom in the stock market. Plus, most of them locked in highly favorable fixed-rate mortgages years ago, so they aren't exposed to the new 3.5% terminal rates on their primary housing. They have high disposable income and are driving robust spending in luxury goods, wealth management, experiential travel.
But the bottom 60% of the economy is a totally different story.
Completely different.
They have burned through whatever savings cushions they had from the pandemic era. And this brings us back to that really jarring image from the beginning of our deep dive. The report highlights a critical masked systemic risk, which they call phantom debt.
Yeah, we are talking specifically about the saturation of buy now, pay later, or BNPL services.
Right.
In their early iteration, these were just fintech novelties. You use them to split the cost of a new pair of sneakers over a few rinse. But today, they have morphed into a fundamental survival mechanism for lower income brackets.
The metrics on this are just staggering. The data indicates that the average household in the bottom 25% income bracket currently carries 4.2 active BNPL loans.
Yeah, shocking.
And nearly 20% of those users are relying on these microloans just to pay for essential weekly groceries and utility bills. It is literally debt stacking, using a microloan to buy food while pushing off a credit card payment.
And the reason the report classifies it as phantom debt is due to the underlying mechanics of how these loans are processed.
Right. Tell us about that.
Because many BNPL plans are structured as simple pay-in-4 installments, they often do not trigger hard credit inquiries.
Oh, wow.
Yeah, therefore, they routinely bypass the major credit reporting bureaus entirely unless the consumer defaults and actually goes into collections.
That is a massive systemic blind spot.
Yeah.
It means millions of active, high-stress loans simply do not show up in official national debt-to-income ratios.
Exactly. So when institutional investors look at high-level banking data, the consumer actually looks relatively healthy. Major financial entities, take Goldman Sachs, for example, they are thriving right now on a massive resurgence in corporate mergers and acquisitions and robust capital markets.
So the top-line banking revenue looks fantastic.
It looks great. But beneath that polished surface, this phantom debt masks severe fragilities in retail and subprime finance. The foundation of the consumer economy is deeply stressed.
Which means if you are an institutional investor navigating this landscape, you have to radically adapt. You have bubbling consumer debt, you have AI rewriting corporate productivity, and you have physical constraints choking digital growth.
That's a lot to balance.
So how is smart capital actually reallocating itself in this environment?
They are completely tearing up the old playbooks. We are witnessing a historic rotation out of legacy technology models. Specifically, institutional capital is abandoning the traditional per-seat SaaS, or software-as-a-service subscription model.
You know, that makes intuitive sense. For the last decade, software companies made their billions by charging businesses a monthly fee for every single employee who used their software.
Right.
But if an AI agent is suddenly doing the work of 10 junior analysts, the company doesn't need 10 software licenses anymore. They need one.
Exactly.
The entire revenue mechanic of the SaaS industry is breaking down. So where is all that investment capital fleeing to?
It is rotating aggressively into what the MacroPulse report dubs the physical AI nexus. Investors realize that pure software is just becoming a commodity. The true value lies in the physical infrastructure required to sustain and power the intelligence economy.
It is genuinely fascinating that the biggest financial winners of the 21st century artificial intelligence revolution are these incredibly old-school, heavy metal industries. We are looking at utilities, heavy industrials, and specialized infrastructure.
The recommended institutional strategy outlined in the documents is a barbell allocation.
Okay, explain the barbell.
Picture a barbell with weights on both ends. On one side, you want highly concentrated exposure to inference-scale technology. You are investing in the absolute choke point technologies that make AI possible. Think of NVIDIA, who designs the critical graphic processing units, or ASML.
ASML is a great example to unpack here. They make the extreme ultraviolet lithography machines that literally print the microscopic circuits onto the most advanced silicon chips. The AI revolution cannot physically occur without their specific machines.
Exactly. That is the sovereign silicon side of the barbell. But to protect that high-risk, high-tech exposure, you hedge it on the opposite side of the barbell with massive physical infrastructure. You allocate capital to heavy-duty companies like Caterpillar, whose earth-moving machinery is required for the multi-billion-dollar factory nearshoring build-outs and grid upgrades. Or you look at a company like Equinix, who essentially operates as the premium landlord for the internet by managing the physical data centers where these servers actually live.
Got it. So you invest in the digital brain, but you heavily hedge by owning the concrete, the steel, and the power lines required to actually house and feed it.
Mm.
It is the classic picks and shovels investment strategy from the gold rush, just updated for the AI era.
Precisely. Because in 2026, intelligence capital is only as liquid as the local power grid and fiber optic cables that transport it.
We have covered an immense amount of ground today.
Yeah,
Let's take a quick breath and synthesize the journey we just took through this intelligence stack.
sure.
We mapped out the great neutrality, the reality that global inflation has a new 3% floor, driven by structural frictions like the invisible insurance tax and the just-in-case supply chain premiums. We unpacked the 100-gigawatt friction point, where the brilliance of agentic AI is slamming headfirst into the physical limits of our power grid. We looked at the biomacro revolution, where GLP-1 weight loss therapeutics are extending the physical working life of the aging population, right as AI hollows out entry-level roles. And we explored the K-shaped consumer, where the top tier is fueling an M&A boom while the bottom tier survives on the hidden, unrecorded risks of phantom debt. All of which is forcing smart money to adopt the barbell allocation strategy in the physical AI nexus.
It is a thorough roadmap of a system under incredible tension. But before we conclude, I want to pull one final crucial thread from the resource annex of these reports.
Okay, what is it?
Well, we have spent significant time discussing the physical constraints of AI, the power grids, the cooling systems, the real estate. But there is one final, ultimate physical bottleneck for this barbell strategy to succeed. It requires an astronomical amount of critical minerals.
The raw materials. I mean, you can't build a new data center or upgrade a global power grid or manufacture millions of high-capacity batteries without copper, cobalt, and rare earth elements.
Exactly.
And traditional terrestrial mines take over a decade to permit and build, assuming you can even access them geopolitically.
Right.
So where is the market looking to source the raw substrate of this new economy?
They're looking to the bottom of the ocean.
Wait, really?
Yes. The intelligence reports define 2026 as the regulatory Rubicon for deep-sea mining.
That sounds like science fiction, but it's happening right now.
It's entirely real. Specifically, institutional capital is focusing on the Clarion-Clipperton Zone.
The what?
The Clarion-Clipperton Zone. It is a vast stretch of the Pacific Ocean floor that is literally littered with polymetallic nodules. These are potato-sized rocks sitting on the seabed that contain incredibly high commercial-grade concentrations of nickel, copper, cobalt, and manganese.
The exact ingredients required for the physical AI nexus.
Precisely. And the robotic technology to harvest these nodules from the abyssal plain already exists, and proponents argue it has a significantly lower carbon and human rights footprint than clear-cutting rainforests for traditional terrestrial strip mines.
Wow.
But the true institutional alpha, the real profit to be made in the coming years, isn't just in developing the extraction robotics.
It's about navigating the geopolitical red tape.
Exactly. It is about securing the legal, environmental, and diplomatic license to operate in these previously untouched global commons. The corporations and sovereign nations that can successfully navigate the International Seabed Authority's newly minted mining codes will effectively control the critical mineral supply chain of the 21st century.
Navigating robotic submarines to harvest the bottom of the Pacific Ocean, just to ensure that an AI agent in a data center has enough copper to balance a corporate spreadsheet in the cloud.
It's a brave new world.
It really is. It is an incredibly vivid image that perfectly encapsulates the absolute friction point of the 2026 economy. As you look at your own portfolio, your own industry, or the skills you are choosing to develop in your career, you have to ask yourself, where does the digital ambition of your field collide with physical reality? Because whoever solves that friction controls the value. We highly encourage you to analyze your own strategies through this new MacroPulse lens. We will be back soon to decode the next stack of signals. Until then, keep questioning the consensus, and we invite you to join us for the next deep dive.